Hey there, and welcome to the Property Wealth Podcast. Today, we've got something really exciting lined up for you. We're diving into the world of emerging hot markets to watch in real estate.
Absolutely, Sarah. There's a lot happening out there, and it's crucial to stay ahead of the curve, especially if you're looking to build long-term wealth.
Right? It can feel overwhelming at times, but that's why we're here. We want to break it down into practical, relatable advice, so you can feel confident in your investment choices.
Exactly. We'll look at a few specific markets that are showing promise and discuss what makes them tick, like job growth, population shifts, and affordability.
And we'll also touch on some of the common pitfalls to avoid when exploring these markets. Because, not every hot market is a safe bet.
For sure. It's all about doing your homework and having a strategy in place.
So if you're over 40 and thinking about where to put your money in real estate, stick around. You won't want to miss the insights we've got lined up for you today.
Let's jump right in and start exploring some of these emerging markets.
Sounds good. So first up, let's talk about a market that's been grabbing attention recently.
So when we talk about emerging hot markets, it's not just about picking a place on a map, right? It's about understanding the bigger picture.
Absolutely. It's about timing and positioning ourselves in a way that, aligns with our goals, especially for those of us over 40.
Exactly. At this stage in life, many are thinking about retirement timelines and how to generate that passive income that can support a comfortable lifestyle.
Right, and with inflation being such a hot topic these days, the idea of investing in real estate becomes even more appealing. Property tends to appreciate over time, which can help protect against inflation, don't you think?
Definitely. I mean, if you look at the history of real estate, it often outpaces inflation. So while prices on everyday goods might be climbing, your property value could be doing the same, or even better.
Yeah, and I think a lot of people might not realize that their homes can be a significant part of their wealth. For example, I spoke with someone recently who had lived in their home for over 20 years. They didn't just see it as a place to live. They viewed it as an investment that appreciated substantially over time.
That's a great example. And, many people are also looking at wealth transfer to their families. Investing in real estate can create a legacy, something tangible to pass down.
Exactly. And it's not just about leaving money behind. It's about creating opportunities for future generations. Imagine your kids having a rental property or two that they can manage as they start their own families.
Right. It gives them an asset that can generate income, which can help with their own financial security. I've seen investors who've built portfolios, and then when the time comes, they pass those properties down, allowing their kids to benefit from that wealth creation.
It's like planting a seed that grows over time, right? But Mike, how do we know which markets are worth investing in, especially as things shift?
Well, that's where research becomes crucial. There are always indicators we can look at, like job growth, migration patterns, and even local government policies that can create favorable conditions for investors.
That makes sense. I remember reading about a couple who moved to a smaller city because they found that job opportunities were expanding there. They invested in rental properties, and it turned out to be a fantastic decision.
Exactly. Often these emerging markets are less saturated than the big cities, which can mean less competition and potentially better deals. Plus, with remote work becoming more accepted, people are moving away from urban centers.
Yes! That opens up a whole new world of opportunity in suburban and rural areas. It's like the pandemic shifted our thinking about where we want to live and invest.
Right. And, even in the face of economic uncertainties, people still need housing. So investing in real estate can provide that emotional side of security.
For sure. I think as we get older, we want to feel secure, not just financially, but emotionally. Knowing that you have a solid investment backing you up can be really comforting.
Plus, it's about having options. If you've built a portfolio, you can choose whether to sell properties, hold them for rental income, or even use them for retirement.
And that flexibility is key. It's not just about the money. It's about having control over your future.
Exactly. And with the current economic trends, there's a lot to consider. Interest rates, for example, can affect our buying power, but they also create opportunities.
How so?
Well, when interest rates are low, it can be a great time to buy. But when they rise, you might find that many investors pull back, creating less competition.
Ah, I see. So, if you're prepared, you might just find a hidden gem during those times when others are hesitant.
Yes, and there's always a market cycle. Understanding where we are in that cycle can help us make informed decisions.
That's a really good point, and I think it's essential for our listeners to remember that investing is a long game.
Absolutely. You're not going to see overnight success, but if you stay the course and invest wisely, you can build significant wealth over time.
Right, and it's about being proactive, not reactive. Keeping an eye on trends and being willing to adapt is so important.
Exactly. And that brings us to the strategies we can use to identify these emerging markets.
Yeah, let's dive into those practical steps that listeners can take to find the right opportunities for them.
Absolutely. Let's get into it. So let's dive into some core strategies and, rules of thumb that can really guide your real estate investing journey, especially when you're looking at emerging markets.
Yeah, definitely. I think having a solid framework can really simplify things. Where do you want to start?
Well, one of the most popular rules is the 1% rule. It's pretty straightforward, really. Basically, the idea is that your monthly rent should be at least 1% of the purchase price of the property. So, if you buy a house for, say, $200,000, you'd want to aim for at least $2,000 in monthly rent.
Right, that makes sense. But what if the market is different? Or you're in a high-demand area where rents are, a bit higher?
Good point. In those cases, you might adjust your expectations. It's not a hard and fast rule, but it's a great starting point to evaluate whether a property has cash flow potential. Just remember, if you're not hitting that 1% mark, you'll want to really dig into the numbers to see if it still makes sense for you.
Yeah, totally. And if you're looking at properties that are a bit more expensive but in hot markets, you might think, well, how do I know if it's worth it?
Exactly. That's where the cap rate comes in. The capitalization rate helps you evaluate the potential return on an investment property. To find it, you divide the net operating income by the property's purchase price. So, if a property generates $20,000 a year in net income and costs $200,000, your cap rate would be 10%.
Wow! That's a really clear way to look at it. So a higher cap rate typically means a better return, right?
Right. But, you also have to consider the risks associated with the property. A higher cap rate might indicate a riskier investment, like a property in a less desirable area.
Makes sense. It's all about balancing potential returns with the level of risk you're comfortable with.
Exactly. And don't forget about the 50% rule, which is a good guideline for estimating operating expenses. It suggests that about 50% of your gross income will go toward expenses. So if your property brings in $30,000 a year, you can roughly estimate $15,000 for expenses.
That's a handy rule. It helps you quickly gauge how much cash flow you might really have left over after those costs.
Right. And once you've applied these rules, you'll want to have a deal evaluation checklist. A step-by-step process can help keep you on track.
What kind of things should be on that checklist?
Well, start with the numbers. Purchase price, projected rent, then move to property condition, location, and local market trends. Also, look at the neighborhood, schools, amenities, and future developments. Those factors can really affect property values.
Totally. And I imagine financing options are also a big part of the equation, right?
Absolutely. Understanding your financing options can make or break a deal. Traditional mortgages are common, but there are also options like FHA loans, which require a lower down payment. And then there's hard money lending for those who might need quick cash, but usually at a higher interest rate.
Right. It's all about weighing those options. So, if someone is just starting out, would you recommend sticking with traditional financing?
Yeah, for most people, traditional financing is a great place to start. It's usually more stable and has lower interest rates than alternatives. Just make sure you're working with a lender who understands investment properties, not just primary residences.
Got it. And what about the types of properties? Are there certain types that are particularly good for emerging markets?
Definitely. Single-family homes are often a good bet, especially in areas with rising populations. But don't overlook multifamily properties, like duplexes or triplexes. They can provide multiple streams of income, and may have better cash flow potential.
That's a good tip. So if someone's considering multifamily, how much more challenging is it to manage compared to single-family homes?
It can be, but it really depends on your comfort level and the systems you put in place. Yes, you'll have more tenants, so there's more responsibility, but with that comes more income. Some investors even hire property managers to help streamline the process.
Smart move. And I imagine understanding the local market is crucial too. How do you gauge that?
You want to look at historical data, price trends, rental rates, vacancy rates, and also pay attention to local news, development projects, and economic indicators. If a company is moving into the area, that usually bodes well for property values.
That's a great approach. And for someone looking to invest from afar, are there tools or resources that can help keep track of those markets?
Absolutely. There are online platforms that provide market analytics, neighborhood trends, and even demographic data. Websites like Zillow or Realtor.com can give you a snapshot, but also consider connecting with local real estate agents or property management companies who know the area well.
That's a good idea. Building those local relationships can really give you an edge.
For sure. And remember, it's essential to stay adaptable. Markets can change quickly, so being flexible with your strategies can help you capitalize on opportunities as they arise.
And speaking of adaptability, what common pitfalls should investors watch out for when diving into these emerging markets?
That's a crucial topic. One of the biggest pitfalls is overestimating potential returns based on hype. Just because a market is hot doesn't mean every property will perform well.
Yeah, that's so true. It's easy to get caught up in the excitement.
Exactly. And then there's the mistake of not doing enough due diligence. Skipping inspections or not fully understanding local laws can lead to costly surprises down the road.
Great points, Mike. I think having that awareness is key to navigating the ups and downs of real estate investing.
Absolutely, and staying informed, adaptable, and connected can really set you up for success in any market.
All right. Well, I think that's a solid overview of the strategies and rules of thumb to keep in mind.
So Sarah, as we dive into these emerging markets, it's really important to talk about some common pitfalls. Mistakes that can trip up even the most seasoned investors.
Absolutely, Mike. I've heard so many stories where things didn't go as planned. What's one of the biggest mistakes you see people making?
Well, one of the big ones is over-leveraging, like taking on too much debt compared to their income or cash flow. I've seen investors buy a property thinking they can manage the mortgage easily, only to realize that, with unexpected expenses or vacancies, they're in over their heads.
Right, that can spiral quickly. Do you have an example of that?
Sure, there was this couple I worked with a while back. They found a property in a hot market, which looked great on paper. They stretched their budget to buy it, thinking they could flip it in a year for a big profit. But then the market shifted, and they ended up carrying that mortgage longer than planned. Not only did they not make the profit they expected, but they also struggled to keep up with the payments.
Ooh, that sounds stressful. It really highlights the importance of understanding your limits, right?
Exactly. And that leads into another common mistake, ignoring cash flow. I can't stress enough how crucial it is to have a clear picture of your cash flow before jumping into a deal.
For sure. It's not just about the purchase price, right? You have to think about ongoing costs, too.
Exactly. I once had a client who bought a rental property without closely examining the numbers. They were so excited about the location that they missed crucial details, like property taxes, maintenance, and even management fees. When the first tenant moved out, they were hit with unexpected costs for repairs that ate into their cash flow.
That must have been a rude awakening for them.
Yeah, and it's a classic example of not running the numbers thoroughly. You've got to account for all these hidden costs that can pop up. It can really change your profit margins.
Speaking of costs, I imagine bad tenants can also be a huge headache.
Absolutely. A bad tenant can turn your investment into a nightmare. I had a friend who rented to someone who seemed great at first. Good references, nice demeanor, but then they started missing payments. And after a few months, it was clear they weren't going to turn things around.
That must have been tough. How did he handle it?
Well, it took a lot of time and money to evict them, not to mention the stress, so it's really vital to screen tenants carefully. Look for red flags during the application process, like inconsistent income or a history of late payments.
Such good advice. And I guess it's not just about the tenant itself, but also about being proactive.
Right. You want to set clear expectations up front and have a solid lease agreement. And here's another pitfall: timing the market. A lot of investors try to predict the perfect moment to buy.
Oh, that's a tricky game.
It really is. I've seen investors wait too long, trying to catch the peak of a market, only to miss out completely. Or they jump in thinking it's the right time, but then the market shifts unexpectedly.
Yeah, and once you're in, it's hard to get out if things go south.
Exactly. Instead of trying to time the market, it's often better to focus on the fundamentals, like the property's potential and your investment strategy.
Speaking of fundamentals, what about those hidden costs? I mean, they can really sneak up on you, can't they?
Definitely. A lot of new investors overlook things like closing costs, insurance, and even homeowners association fees. I had a client who was blindsided by the amount he needed for repairs after closing. He thought he was fully funded for the purchase, but then found out he needed thousands more to get the property up to standard.
Wow, that's a tough lesson to learn.
It really is. And that's why I always recommend having a contingency fund. Like, at least 10 to 15% of your budget set aside for those unexpected expenses. It can save you from a lot of stress.
Such a practical tip. And how can people spot these red flags early on?
One key thing is to do thorough due diligence. Research the property, the area, and the rental market. If you notice a property has been on the market for a long time, that can be a red flag. Also, look at the local economy. If businesses are closing down or there are high vacancy rates, it might be time to reconsider.
Yeah, and maybe even talk to locals or other investors, right?
Absolutely. Networking can provide insights you won't find online. And if you're feeling uncertain, don't hesitate to consult with a real estate advisor. They can help you navigate these challenges.
Such great advice, Mike. It sounds like the key takeaway is to stay informed and be prepared, right?
Exactly. Being proactive and staying educated can really set you up for success.
And if things do go wrong, it's not the end of the world. There are always ways to recover.
Definitely. It's important to learn from mistakes, adjust your strategy, and keep moving forward.
I love that mindset. So what's next for our listeners?
Well, I'd suggest they start by assessing their own investment goals and strategies, and maybe even revisiting some of their past decisions to see what they can learn from them.
That sounds like a solid plan. It's all about continuous learning and adapting in this game.
Exactly, Sarah. The more informed you are, the better prepared you'll be to seize the right opportunities in these emerging markets.
And with that, let's move forward and explore how to take those next steps.
So let's dive into some immediate steps that anyone can take right now, to start exploring these emerging hot markets.
Yeah, that sounds great. I think a lot of folks might feel overwhelmed, but really, it's about taking those first small steps, right?
Absolutely. One of the simplest things you can do is start looking at online platforms like Zillow or Realtor.com. These sites are gold mines for discovering market trends, property values, and rental rates.
Right. And you can filter by location, price, and property type. It's like having a virtual window into different markets.
Exactly. And while you're at it, check out local MLS access if you can. That'll give you even more detailed data on the properties in a specific area.
Oh, and the Bigger Pockets calculator is a must-have tool too. It helps you analyze potential deals, and it's super user-friendly.
Yeah, I love that tool. You can run numbers on cash flow, ROI, and even compare different properties side by side. It's so helpful to really see the numbers laid out.
Speaking of analysis, I think one habit to get into is analyzing at least one deal each week. It doesn't have to be a serious investment. Just practice looking at the numbers and understanding what a good deal looks like.
That's a great point. Just getting into that habit will sharpen your skills over time. Plus, it'll help you feel more comfortable when you see a property that catches your eye.
And if you're looking for something a bit more interactive, consider joining a local real estate meetup group.
Oh, definitely. Connecting with other investors can provide insights into what's happening in your area, and you might even find a mentor or someone to partner with.
That networking piece is so valuable. And don't forget about podcasts and books. There's so many great resources out there.
For sure. I'd recommend The Book on Rental Property Investing by Brandon Turner. It's a classic. And there are podcasts like Bigger Pockets Podcast that cover a wide range of topics, from market trends to personal stories of investors.
Those are fantastic resources. It's all about learning from others' experiences, right?
Exactly. And, if you're looking for something a bit more niche, check out local real estate investing podcasts focused on your area. They often highlight what's hot in your market.
That's a smart idea. It's like getting insider knowledge without having to go through the grunt work yourself.
And speaking of grunt work, if you're diving into specific markets, don't forget about tools like Rentometer. It's great for quickly assessing rental rates in different neighborhoods.
Oh yes, that way you can figure out if the numbers work for your investment strategy.
And remember, it's important to start small. You don't have to jump into a huge investment right away.
Right. Maybe start with a single-family home or even a small duplex. It's all about building your confidence.
Yeah, and as you gain experience, you can scale up. Just make sure you're always doing your due diligence.
For sure. And let's not forget the importance of keeping up with market news. Subscribing to local real estate newsletters or following local agents on social media can keep you informed.
Absolutely. Staying updated on local economic trends, job growth, and even city plans can give you insights into where to invest next.
I love that. It's like piecing together a puzzle, and each piece of information helps you see the bigger picture.
Exactly. And don't be afraid to ask questions, whether it's in meetups or online forums. The real estate community is usually pretty welcoming.
Yeah, that's a good reminder. Everyone starts somewhere, and most investors are happy to share their knowledge.
So, with all these tools and habits in mind, it's really about just taking that first step. Start where you are and keep moving forward.
Definitely. And it's exciting to think about how even small actions can lead to significant changes over time.
So those are some practical first steps. Now let's bring this all together. So as we wrap things up, let's recap some of those key takeaways from today's discussion about emerging hot markets.
Yeah, definitely. First off, it's crucial to keep an eye on those up-and-coming areas, right? Markets like Nashville and Boise are really showing potential for growth.
Exactly. And remember, it's not just about the current hype. Look for long-term trends, like population growth and job opportunities.
Right. And the importance of local economies can't be overstated. A strong job market often means more demand for housing.
And don't forget about the significance of infrastructure development. Areas with new transportation links or schools can really see property values rise.
Absolutely. And of course, always do your research. Understanding market cycles and timing your investment can make a huge difference.
Well, we hope this gives you some solid insights into where to focus your efforts. Building wealth through real estate is a journey, and every bit of knowledge helps.
Totally. So if you found this episode valuable, please like, subscribe, and comment below with your biggest takeaway or any questions you might have.
And if you know someone over 40 who's thinking about diving into real estate investing, share this episode with them. It could really inspire them to take that next step.
Yes! And don't forget, next time, we'll dive into Sunbelt migration and the real estate trends that come with it. You won't want to miss that.
Exactly. There's so much happening in those markets.
Thanks for joining us today, everyone. Remember, every step you take is a step toward your financial future.
Take care and happy investing.